Okay, well, let's just begin here. Let's start here. This just shows you what the revenue was for the fiscal year that ended June 30. So as you can see, the net total revenue was $524.8 million. We had a negative investment return. We lost $54.6 million, but that was more than offset by contributions coming in from the employers, employees, and miscellaneous sources. And then these are the stats that back it up. In terms of expenses, as I'm sure you already know, the overwhelming payments that go out of this system in any 12-month period of time are for benefits of one type or another. Now, the most prominent, obviously, is retirement benefits, but there are also survivor benefits, disability benefits, insurance, premium subsidies, drop payments to persons who are leaving the drop program in PSPRS, and then refunds to terminating members. The administrative expenses to run the system are a very, very small portion of outlays. It was around $9 million in fiscal year 2012. Cash flow is normally negative. All we're showing here is contribution income from employers and employees coming in, and benefit payments and other miscellaneous expenses going out the door. So fiscal 2012 was not unusual, and in most years, any negative cash flow is more than made up by the investment return on the invested assets. Unfortunately, last year was an exception to that rule. This is the old asset allocation. This is the way things were when we were attempting to manage all the assets internally here. This is about the time that I started. This is the asset allocation as of June 30, 2006. This allocation was truly lacking in diversity. The stock component was really just the large capitalization and mid-capitalization portions of the U.S. stock market. There were no small cap stocks. There were no international stocks, no emerging market equity, none of the kinds of diversified investments that other public funds had at the time. I'll comment on this too. Real estate, this is certainly not the investable real estate universe by any means. This was almost totally residential real estate development properties concentrated here in Arizona and in the contiguous states of the Southwest. So one of the things we did do, and over the past several years, ever since we got the authority to use external managers in 2008, is to diversify the asset allocation. So this is now a fully diversified asset allocation, and we're diversified within the components of it as well. So for example, the U.S. equity component reflects the entire U.S. stock market, as does the international equity component. That reflects the total investable non-U.S. stock market. And the purpose of diversification was, number one, to reduce risk, and number two, to generate a more stable pattern of returns. This is the rate of return story for the fiscal year 2012. We had a gross of fee negative return of 0.32%, and we underperformed the benchmark, which at least was positive, although only slightly so. That came in at 2.89%. Now keep this in mind, this is important. The actuarial assumed rate of return for these plans in fiscal year 2012 was 8%. So we have a very large actuarial loss due to investment return as a result of what happened in fiscal year 2012. Now, the fact that we underperform the benchmark is something that we have already taken steps to address. This is the attribution analysis of what happened. On a net of fee basis, the fiscal 2012 return was a negative 0.79%. The benchmark was 2.89%, so the underperformance was 3.68%, or 368 basis points. And this portion of this frame identifies the sources or the factors contributing to that. And the biggest one is this one. It's labeled real estate joint venture only. What this is hopefully the last write down in the values of the residential real estate properties which were invested in many years ago. We have, over time, had appraisals done on portions of this portfolio, and we hope that fiscal year 2012 sees the last of the write-downs. In fact, given the revival of the real estate market nationally as well as here in the Southwest, we actually expect to begin to see some gains now. We'll be writing up the value of these assets, hopefully going forward, unless something unexpected or unforeseen happens. There were some other factors contributing as well. There was a market timing play that was not successful, so we won't be doing that anymore. And we actually had an inappropriate benchmark for the credit opportunities component, and that actually inflated the total benchmark return and therefore understated the performance. And that has already been addressed. Now, this is what it looks like as of right now in the new fiscal year. So from July 1 of last year through the end of November of this year, I'm sorry, calendar 2012, we have a 4.68% return, which is better than the benchmark return for the same time frame. And I understand that the return for the month of December was pretty strong. It was well in excess of 1%. And that we actually added to our outperformance relative to the benchmark in December. But we don't have final numbers for December, so I didn't want to include them in this particular frame. So at this point, I can say that as of the end of December, it looks pretty good that we will at least make our actuarial assumed rate of return assumption for fiscal year 2013. And that assumption for this fiscal year is 7.85%. I'll come back and talk about that toward the end of the presentation. Okay, that moves us to this. This frame simply shows you what the old asset allocation was. We made some minor revisions to that were adopted and went into effect July 1 of last year. So that's the start of the new fiscal year. This shows you the returns over the 1, 3, and 5-year periods ending June 30, 2012. The 3-year return is actually pretty strong. That's an annual average return in excess of 10%. But the 5-year return is really dismal. And think about that. We had actuarial assumed return of 8 or even 8.5% in the earlier years. So certainly the financial markets have not been at all kind to us. And I'm not sure that they're going to be going forward. Okay, at this point, any comments or questions about the rate of return story? It's debt instruments. Back in 2008 and 9, a lot of the U.S. financial institutions had to raise capital, and they did it by selling securities that they owned, mortgage-backed securities and things like that. Well, investors went out, or general partners went out and raised funds to purchase those at deep discounts. And so we invested as a limited partner in several of those funds. And so what we've been getting in credit opportunities, or that component, is basically equity returns with bond-like risk. But that particular opportunity is going away, or shifting, because the same opportunities which were present in the U.S. Market because of what was happening in the financial institutions in 2008 and 9 are now shifting to Asia, and will be shifting in Europe as well, although that hasn't fully happened yet. Okay, let's go to the next topic, and this has to do with return, but return as it relates to what happens to the funding ratio of the plan. When you look at this historical chart, you can see what the investment return was year by year relative to the benchmarks going back to fiscal year 2001. Well, here we had a very sharply negative return in both of these fiscal years, and that simply reflects the fact that at that time, the portfolios that were being managed and invested in-house for both stocks and bonds were highly concentrated in high-tech and telecommunication securities. And so when a WorldCom went to zero, anything we had invested in WorldCom stock and bonds also went to zero. And that concentration really hurt this system because the investment return for any 1 year takes a full 7 years to be reflected in the actuarial value of assets. So when something like that happens, it takes a long time until we get over it, the full 7 years. Now in this period here, from 2003 through 2007, you see things look, well, they look more normal. The results are positive, and in most years we outperform the benchmark. But the sad fact is that because of a lack of diversification, we were missing opportunities in some of the best performing markets during that time. During this period, actually the best places to be were things like international equities and emerging market equities. We had no exposure to these things. Also, we had no exposure to small cap U.S. equities. And that too was a very good performing subset of the U.S. stock market at the time. And the reason we didn't have those exposures is because we couldn't get them by trying to manage all these assets in-house. We had to use external managers. And so in 2008, with the help of some lobbying firms that we hired, and in fact we still have, we were able to get authorization to use external managers. And we began to diversify the exposure of the funds at that point. Unfortunately, that happened to coincide with the deflating of the real estate bubble, which in turn was followed by the intense recession and the collapse of the financial markets, especially in 2009. So here in 2009, we had a sharply negative return, but we outperformed the benchmark by quite a bit. But so what? On an absolute basis, this was a terrible result. And we are still having to live with the negative returns from fiscal years 08, 09, and now most recently fiscal 2012. So what this picture is telling you is that in the last 5 years, we've had 3 years where we have had investment return that has been less than, and significantly less than, the actuarial assumed rate of return for those years. And the effects of that will be with us for quite some time. And as that happens, the funding ratio for the plans deteriorates. And that has been the trend over this entire period of time. So no matter which plan you're looking at, these funding ratios, which is simply the actuarial value of assets at fiscal year end divided by the liability for benefits at fiscal year end. And that trend has been going down. So at June 30, 2012, the funding ratio for the PSPRS plan came in as 58.6%, and for EORP it was even worse. The funding ratio there was at 58.4%. And as funding ratios have come down, the employer contribution requirements have gone up, and they have gone up dramatically. This is the average or aggregate employer contribution rate for all the employers contributing to the PSPRS plan. So the current rate, in effect right now, the aggregate current rate is 27.18% of payroll. Based on system fiscal 2012 results, that aggregate or average rate is going to rise to 30.44% of payroll effective July 1 of this year. The same story is true of CORP, although it's not as bad, but the trend is still for higher contribution requirements by the contributing employers to that plan. Currently, the aggregate or average contribution from the employers is 11.3% of payroll. That's going to go to 13.68% of payroll on July 1. And for EORP, the employer contribution story is even worse. There were actually two contribution rates here. The rate paid by cities and towns with respect to their elected officials who are in that plan is currently 36.44%. That's going to rise to nearly 40% of payroll this coming July 1. For the state and the counties, part of whose contribution rate is subsidized by court filing fees, the current subsidized rate is 20.87% of payroll. That's going to go to nearly 26% of payroll this coming July 1. And given the fact that we're still working through or working off those actuarial losses from fiscal years 2008 and 9, and now most recently fiscal 12. These contribution rates are going to continue to escalate, and the funding ratio, at least in the short term, is going to continue to deteriorate. The only thing that would really improve the picture as far as contribution requirements and funding ratios go would be a very robust and sustained rate of economic growth, both in the U.S. and globally, and also a robust rate of return from the financial markets that would reflect what's going on in the economy. I don't see those kind of forecasts in the future. I see forecasts calling for more and more volatility, and that's what we've been struggling with for the last few years. Okay, this historical table is of some value because you can see what has really happened in terms of the market value of assets for the system over this entire period of time. So we go back to June 30 at 2000, the market value of assets was a little over 5.6 billion. All right, 2 years later, market value of assets is down to just under 4 billion. And that is attributable to what happened in the tech and telecom world. And then we get back to roughly 5.6 billion at June 30, 2006. However, during that time frame, the liabilities for benefits went from 4.2 billion to 7.9 billion, 90% increase in liability. So that certainly took its toll on the official funding ratio. And as you can see, there's a big difference in these numbers still. And if we were doing the funding ratio calculation, which officially at June 30, 2012, for the three plans combined was 60.2%, it would be only 50.6% if we're using market value.
Yeah, Jim, with respect to revenue streams, what would be the impact, if any, to, for example, hypothetically, 500 new officers to 1,000 new officers? I'm talking about new hires now, to that scenario.
It would help. I mean, that would produce an actuarial gain, and it would help offset some of the actuarial losses that we've had in the past, because payroll would be expanding more than expected. The actuaries assume that payroll is going to grow every year, but they've revised their assumption. They used to assume that payroll was going to grow 5% a year. They've revised that down to 4%. So if we have a year when the government hires more people than expected, then that produces an actuarial gain. But that can be a two-edged sword if, at the same time, salaries are growing, because salaries drive liability for benefits, since benefits are tied to salaries. So you have to really look at both pieces of it, and you have to wait until the fiscal year-end results to really get a net result for that. Well, I don't know this to be a fact, but I have heard that there are very large numbers of vacancies, for example, in the Phoenix Police Department, and probably in the fire department too. Tim, you probably know. And it's simply because people are leaving and they're not being replaced for whatever reasons, maybe just budgetary constraints and having to continue to meet the financial requirements for the pension system. Okay, the next few frames just break this out on a plan-by-plan basis. So if we were using market value, the funding ratio June 30, 2012, PSPRS would be just under 50%. For CORP, it's better, although not great. The funding ratio would be 57.7%. And for EORP, which is now the worst of them, the funding ratio would be only 48.7%. This is, I guess for lack of a better word, I'll just call it the COLA story. Under prior law, prior to the pension reform bill in 2011, any year that PSPRS generated a rate of return in excess of 9%, 1/2 of the excess return over 9% would be earmarked into the reserves that each of the plans had. And then those reserve assets would be drawn upon to fund, on a present value basis, annual adjustments for all of the eligible beneficiaries. And that system certainly provided generous compounded annual increases for eligible beneficiaries going back many, many years. Ever since the that COLA mechanism or COLA formula was designed and put into the state statutes. Now, in 2011, the legislature, of course, passed the so-called pension reform bill, and that did two things. Number one, it said that as of May 31, 2011, there will be no new inflows of assets to the reserves, regardless of the system's rate of return. It just so happens that in fiscal year 2011, the system had a rate of return in excess of 17%. So that law blocked what would have been very large inflows of new assets to the reserves. And I'll show you that in just a moment. The other thing that the pension reform bill did was to put in place an entirely new mechanism for post-retirement adjustments, and that new mechanism will go into effect July 1 of 2013. Now, the law allowed for a continuation of benefit adjustments as long as there were assets in the reserves, and there were at June 30, 2011. Therefore, the plans provided increases for all eligible beneficiaries effective July 1, 2011. In fact, there were so many assets in the PSPRS reserve that regardless of the fact that the adjustment on July 1, 2011 cost the PSPRS reserve nearly $155 million, it still left a substantial balance at that point of $168.3 million. And that balance was then used to finance a post-retirement adjustment for all the eligibles effective July 1 of 2012. But as of that point, the PSPRS reserve balance is now zero. In 2011, at June 30, both CORP and EORP had reserve assets. And those assets were used entirely to fund that year's post-retirement adjustment for all of the CORP and EORP eligible beneficiaries. And once that was done, the balances remaining for the CORP and EORP reserves was zero. And there was no increase provided for CORP and EORP beneficiaries in July of 2012. And there can't be now until the new mechanism takes effect July 1, 2013. Okay, that's the effect of the pension reform bill as it relates to post-retirement adjustments or COLAs. But those changes by the legislature are being challenged in the courts. There are 4 cases outstanding right now. The first case was filed on behalf of all the judges who were retired when the pension reform bill became law. And that became law on July 20th of 2011. The second, and that lawsuit is simply challenging the constitutionality of what was done as it relates to the COLA changes and the effect on persons who were retired at that time. The second lawsuit that was filed on behalf of active judges who were contributing to the EORP plan as of July 20, 2011. And that lawsuit is challenging the COLA changes as they relate to persons who were active at July 20, 2011, and also the increases in member contribution rates, which were also increased by the pension reform bill. The other 2 cases sort of mirror this. There was a case filed on behalf of police officers who were retired at July 20, 2011, and that lawsuit is simply challenging the COLA changes, but in the context of the PSPRS plan. And the other lawsuit, the final one, was filed on behalf of active police officers, and that one is, like the active judges, that one is challenging both the COLA changes and the increases in member contribution rates. Now, these cases are not that far along. Ultimately, we will need to have decisions from the Arizona Supreme Court before we know what is constitutional and what isn't. But until we have that, we really don't know what the status is going to be. But we could find out at the end of the day when the Arizona Supreme Court rules that everything that the legislature did with respect to COLAs and with respect to member rate increases is unconstitutional. Well, now if that happens, then we have to go back and undo what was done. We have to, in other words, revive and put back into place the old COLA mechanism. So, for example, we would have to go back to June 30, 2011, and during that fiscal year, the system had a very strong return. As I said earlier, we had a return well in excess of 17%. And so we would have to take assets from the underfunded underlying plans, in fact, $274.5 million of assets, and allocate them as you see. The PSPRS reserve would get 193.6 million, Corp reserve would get nearly 50 million, and the EORP reserve would get a little over 31 million. And then there would be adjustments made in the benefits that were effective in July of 2011. The Corp and EORP beneficiaries did not get increases at the statutory 4% maximum. They got something less than that because there were only sufficient assets to support the lower amount. We'd have to adjust that because now there's plenty of assets. And in fact, there would have been assets left over. At July 1, 2011, the PSPRS reserve would have had nearly 362 million. Corp would have had a little over 46 million. And EORP would have had 26 million. And that means that in 2012, the PSPRS eligibles would get an adjustment because they didn't get an increase at the statutory maximum. And the Corp and EORP eligible beneficiaries would get an increase, which of course they didn't get because the balance in the reserves was zero. And so we would simply be going back and putting back into place everything that was there before the legislature intervened in 2011. And we have been tracking all of this. So in case the courts do decide that these changes are unconstitutional, we can in fact go back and redo all of this. Okay. In the fall of 2010, the Board of Trustees here had the systems actuaries from Gabriel Smith and Company do stochastic projections. These are probability series. And what they wanted to do was to find out what happens if nothing is changed in terms of the provisions of the PSPRS plan. So this first set of projections was done, it was based on PSPRS 2009 results, because at that point, those were the latest results they had. And to do these projections, the actuaries had to get from the systems investment consultants their forecast of what the various financial markets would be providing in the future on average, given where we had assets deployed for investment. And to make a long story short, the investment consultants told the actuaries that on average, over time, the markets should provide a market return of about 8%. And they also told the actuaries that we could expect that the actively managed portfolios of the system would add an additional 0.5%. So the expectation was that on average, over time, the rate of return should be 8.5%. Well, this projection sort of confirms that. This line here, this labeled median, is actually the 50% probability line. And what it tells you, you look at when you go out over the long term, you see a return of 8.4, 8.5%. So that's what was expected given the forecast we got from the investment consultants. But that projection didn't take into account the fact that there will be years when the system generates a return over 9%. And as I said earlier, anytime we do, 1/2 of that return goes to the reserve and doesn't help the underlying underfunded plan. So the actuaries had to take that into account, because there definitely will be years when we do have rates of return in excess of 9%. There are going to be years when we have rates of return under 8.5%. So when they did the projection, to find out what really is going to be going into the underfunded PSPRS plan, on average over time, the picture changed dramatically. Again, just go to the median line, 50% probability. What you see is not 8.5% anymore. Now it's more like 6.6 or 6.7%. And the difference between the earlier frame and this one is simply reflects the cost of the COLA program. So that's a very expensive, what they told the board was that's a very expensive mechanism. And the consequences of that have to be made up really by the employers. So that is what generated the, or impelled the legislature really to address the whole COLA mechanism in the context of the pension reform bill in 2011. Okay, so let's go to this. These projections have been updated. They're now based on fiscal 2012 results. Again, these are stochastic projections. There are various probability levels here. And what we're showing you is what would have happened to the PSPRS plan if the legislature had changed nothing. Okay, so the lower part of the table shows you funding ratio, and the upper part shows you the employer aggregate contribution requirement on a year at various points in time going out to 2052. Well, let's go out 20 years from 2012 to 2032. And what this shows you is that nothing had changed. There's a 50% probability that the PSPRS plan would have a funding ratio of not less than 76.9%. And in the same year, the employer contribution requirement at a 50% probability level would not be higher than 36.1%. Now, if you want a higher degree of confidence, you go to a higher probability level. So let's just for the sake of discussion here, focus on this. 75% probability in 2032, the funding ratio would not be lower than 69.1%, and the employer rate would not be higher than 43.1%. Okay, now we go to the next frame. This captures the effect of what was done in the pension reform bill. And again, the factors that really contributed to the financial improvement, if you will, were the changes in the COLA and the changes in member rates, because anything they did with respect to new hires just pales into insignificance relative to those other two factors. So when you, again, look at the 50% probability level and go to 2032, you can see that 50% probability, the funding ratio would not be lower than 89.5%, and the employer contribution requirement would not be higher than 21.8%, less than it was in 2012. So there's a big difference if you compare what would have happened on the baseline scenario with what happened as a result of the changes that the legislature made. So another way to look at it is to say, well, if the Arizona Supreme Court overturns the COLA changes and overturns the member rate increases by finding them unconstitutional, then instead of this picture, we'll go back to the this picture. And what it'll mean is funding ratios will be lower than what otherwise be the case, and employer contribution requirements will be higher than would otherwise be the case. And that's true for all the plans to one degree or another. EORP did see some improvement as a result of what happened in the 2011 legislation. Baseline, nothing had changed, shows the elected officials plan in 2032 with a funding ratio of 72.4% and an employer contribution requirement at 35.9%. The pension bill had some did improve that picture a bit. Now you can see at the 50% probability line, you've got a funding ratio of 90.7%, and an employer contribution requirement of 29.5%. Now that's the unsubsidized rate, by the way. Okay, every 5 years, the system has to have its actuaries do an experience study. And 2012 was the year for that. Well, when they do an experience study, the actuaries come in and they simply test all of the assumptions that are used in doing the valuations for the plan. So those assumptions break down into two categories. There are the demographic assumptions, like mortality and incidence of disability, and then there are the economic assumptions, which are the rate of return assumption and the salary growth assumption, which the actuaries call wage inflation assumption. And when the actuaries came in May to report to the board on the results of the experience study, what they told the board was that they were recommending changes in some of the demographic assumptions. Some of these resulted in actuarial gains to the plans, others resulted in actuarial losses, but on a net basis, there was really no change as a result of the demographic changes, so the board adopted. They also recommended changes in the economic assumptions. And the changes they recommended were a decrease in the payroll growth or a wage inflation assumption. They were recommending that the 5% assumption that was in place be reduced to 4% in 2 steps, basically over 2 years. So it comes down to 4%. And they recommended that the rate of return assumption, which was in 2012 8%, be reduced, again 2 steps, to 7.5%. So it would be a 7.5% assumption effective in system fiscal 2014. Now the board adopted the change in assumption as it relates to the wage inflation, but they did not go to a 7.75% assumption for fiscal 13. Instead, they reduced the assumption from 8% to 7.85%. But they will get to 7.5% probably by 2014. And the reason for that, it's a valid reason, is that the actuaries were telling the board that once this new COLA mechanism goes into place, July 1, 2013, it will provide periodic increases in benefits. And to that extent, it has a cost. And that cost, they compute, is going to absorb roughly 1/2 of 1% of return on average over time. So if you want to use an assumption that's correct for the underlying plan, it's appropriate to go from 8% to 7.5% because that's what it is. And that is in fact what would happen. The problem is that any time you lower the rate of return assumption by 1/2 of 1%, employer contribution rates rise on average by about 3% of payroll. And that is exactly what you see here. The PSPRS employer contribution rate goes from 28.9% to 31.9%. And that just confirms that rough thumbnail. Yes?
Run up here.
Yeah, please.
Can you just briefly describe for us, I know you've told us before, what is the new mechanism for COLAs if the law moves forward that way? What is that actual mechanism?
Well, first of all, there were no reserves. But anytime the system generates a rate of return in excess of 10.5%, the entire return over 10.5% will be used to fund a COLA. But the percentage of increase in member benefits will vary depending upon the system's funding ratio at that time. If the funding ratio is less than 60%, there'll be no COLA adjustment at all, even if we do make a return in excess of 10.5. And then, then it'll vary. It'll be anywhere from 2% to 4%, depending on what the funding ratio. And that so if we're funded at better than 60%, but we're up to 80%. At 80%, if there were enough money in excess return, it could fund a 4% increase in benefits. So the best thing to do is to go to the PSPRS website where you'll see the breakout, how that's calculated. Tim?
My question is about the ultimate goal to get to the 7.5% assumed earnings rate. I think you said earlier that the investment advisors had said that expect an average rate of return of 8%, and the active management will give you an additional
8.5.
an additional 0.5%. And if the new COLA mechanism costs the same, costs 0.5%, why would we then go down to a 7.5% assumed earnings rate if the projections are for 8%?
Well, when the actuaries went to the consultants asking what the financial markets would provide, so they could do that first round of stochastic projections back in the fall of 2010, they were projecting an annual average rate of 8.5%. Since then, the investment consultants revised down their forecasts of return from the financial markets. So now we're looking at 8%. That's the reason. Okay, there's still more to this. This shows you what it looks like for CORP and for EORP. We're back to the issue of the lawsuits. Okay, so two of the lawsuits apply with respect to persons who were already retired when the pension reform bill became law. And they were vested in their benefits. And so they were not affected by what we call the vesting provision. In 1983, the PSPRS statutes were changed. And at that point, a new provision was introduced that basically says you don't vest with respect to any benefits until you apply for and are found eligible for retirement benefits. That change in the law became effective on July 27th, 1983. And so it is, in effect, a change in the contract. And anybody who became a participant in EORP after that point in time, theoretically, is subject to that vesting provision. So that provision has never been tested in the courts, but it will be tested in the context of the lawsuits that are in process on behalf of the active judges and on behalf of the active police officers. In the context of PSPRS, as of July of 2011, we only had, according to our count, 109 persons who actually became participants in PSPRS prior to July 27, 1983. The overwhelming majority of participants, 18,529, became members of PSPRS on or after July 27, 1983, and theoretically, at least, they are subject to that vesting provision. But again, as I said, that provision has never been challenged in the courts. We don't know what the courts are going to say about it. They might say that that provision was unconstitutional on its face because it converts what was a right into a mere gratuity. Because the legislature could take it away at any point in a person's career prior to retirement. Will?
And doesn't it also conflict with the 98 constitutional amendment, which was passed
It may.
by the voters?
It
could.
Yeah.
Potential.
That's possible. We don't know what the courts are going to say about it because it's never been challenged or tested. Now, in CORP and EORP, it's a little more complicated. The CORP and EORP statutes have exactly the same provision, but they were enacted at different points in time. The CORP and EORP vesting provision was enacted in 2000, became effective July 18. The legislature made that provision retroactive to the inception of the CORP and EORP plans. So that is a different situation from the PSPRS. But in terms of numbers, let's just look at EORP here. As of July 1, 2011, we have 188 active participants who became EORP members prior to July 18, 2000, and 657 who became members on or after that date. Now, the courts could say that if they uphold and find constitutional that vesting provision, that what the legislature did in 2011 with respect to COLA and member rates applies, but it only applies to persons who became members on or after the effective date of the vesting provision. They might say it doesn't apply to anybody who became a member before then, but then they have to decide whether the retroactive feature is constitutional or not. So it's possible that at the end of the day, when the Arizona Supreme Court finally gets around to it, we could have different results for different groups in each of the plans, depending upon when they became members of the plan relative to the July 20, 2011 date. And at this point, I can't predict what the Arizona Supreme Court's going to do. At this point in time, we have only one decision, and that's from the Superior Court in the so-called Fields case, which is the retired judge's case. In that case, the Superior Court found that the COLA changes, as they relate to persons already retired, was unconstitutional. That case is going to be appealed. It'll either go to the Court of Appeals or it'll go directly to the Supreme Court if the Supreme Court agrees to take the case directly and bypass the Court of Appeals. We don't know whether that will happen or not. If the case goes first to the Court of Appeals, it'll probably delay getting a final determination from the Supreme Court by about 18 months. Frankly, the sooner we have a decision as to what's constitutional and what isn't, the better, as far as we're concerned, because the longer it takes, the more difficult it's going to be to undo this and sort of put Humpty Dumpty back together again. We just don't know how long it's going to take. It would be helpful for the Supreme Court to take these cases directly, because there was a lot of issues that have never been addressed by the Arizona Supreme Court in any context. So that's where we are. We're sort of on hold, waiting for things to happen. But obviously, if the courts at the end of the day overturn what the legislature did with respect to COLA and member rates, then there's going to be an enormous increase in employer contribution requirements. That's just simply, but that would happen automatically. Okay, any comments, questions? I don't have anything good to say. The only good news in here is that so far in this current fiscal year, we're on track to meet our rate of return expectation target of 7 and 8.5%. Small change, but whatever. Better than nothing. But I'm not going to promise what's going to happen in the remaining 6 months of the fiscal year. I don't know. I mean, we just went through the fiscal cliff debate in Washington, and now there's going to be, the debt ceiling debate, and we just lurch from one crisis to another, and of course that makes for volatility in the markets. I don't know what's going to happen. Okay, any?
One question.
Yep, Brian.
As far as these cases going forward to the Supreme Court and so forth, is the Attorney General going to be representing the state on behalf of this, or is the system hiring counsel and will we be incurring those fees out of the fund?
Oh, thank you for asking that question. All the lawsuits, every one of the lawsuits named the trustees of the system as defendants. They didn't name the state, they didn't name the legislature. So when that happened, we asked the logical question. Obviously, the board needs defense counsel. But the question was, is the Arizona Attorney General's office going to intervene in order to defend the constitutionality of what the legislature did? That really wasn't our job. And initially, the AG's office was not inclined to do that. But then they changed their mind. So they finally intervened in the Fields case first, and since then they have intervened in all all of these cases. And their job is to basically argue that what the legislature did is constitutional. Nevertheless, the board members are individual named parties in these cases, and they have their own counsel. And quite frankly, they have very good counsel. So I think you understand the board has chosen not to have the AG's office represent us because we're not defending the constitutionality of what the legislature did. That's the AG's responsibility on behalf of the legislature. Now, there is a motion pending right now that was filed by the attorneys for the trustees that is asking the Supreme Court to take the Fields case directly and bypass the Court of Appeal, obviously to save time, and also because of the fact that the cases involving the judges were filed on behalf of active appellate court judges or retired appellate court judges, and there's an appearance issue if they run it through the Court of Appeals, because every single member of the Court of Appeals is part of the class. So, and that I'm told that motion has been joined in by the governor's office and by the legislative leadership. But I don't know what the Supreme Court will do. They can grant that motion as a matter of discretion. There is no absolute right to go directly from the Superior Court to the Arizona Supreme Court. So that's why I say we're still kind of on hold. All right, let me just say a couple other things on other topics. As is normally the case, we have had administrative bills drafted, and we are having 3 bills introduced. One contains administrative changes for the PSPRS plan. The second contains the administrative changes for the CORP plan. The third contains the administrative changes for the elected officials plan. I'm going to have the draft bills, which we just got, put out on the system's website later today, so you can access them, take a look through them. These administrative proposals are just designed to clarify the statutes. They're not making substantive changes, but nevertheless, they do need to be reviewed because every set of eyes is welcome. And sometimes in the drafting process, things happen that aren't unintended. So I do encourage you to take a look at those proposals to the extent that they affect your particular constituencies, and let us know if there's anything you see with respect to the current drafts that might be a problem, because we can get them corrected. There should be no financial impact whatsoever from these bills, but those are the only initiatives that the trustees of the system have authorized for this next legislative session, at least as far as we're concerned. However, that doesn't mean there won't be other pension bills. There will be. The one that's been talked about the most is a proposal in one form or another to close the elected officials plan and put in place a substitute plan, and I can guarantee a much less generous plan for new hires who become participants in EORP in the future. Now, at this point, it looks as though that new plan will take the form of a defined contribution plan, but how generous it is and how it's going to work remains to be seen. I have not seen any draft of that yet, as of this point in time. Of course, the system will be asked to do actuarial projections once we have the specifications for this proposal. But I am expecting this is going to be forthcoming from the leadership in both the Senate and the House. But I have been told that there will be no effort to close the defined benefit plans for PSPRS or for CORP. There was as I'm sure you may know, there was an attempt made at the very end of last legislative session to close the elected officials plan. That didn't happen. And I don't know that there's any guarantee that an initiative to close the EORP plan, even if it is supported by the leadership in the Senate and the House, will actually pass, let alone be signed by the governor. We just don't know. So it remains to be seen, but I do think that's going to be a focus of attention. And there may be other bills. Lawmakers may have other ideas as to what should be done or could be done or whatever. And any information that we have on legislative proposals will be made available via the system's website. So we'll continue to track things, and we'll be doing things at the request of the Joint Legislative Budget Committee, because they always come to us whenever there's the fiscal note requirement for any proposal that may be out there that's going to be subject of legislative hearings. The first hearing that we have been invited to participate in is going to be held in the House. That'll be the Insurance and Retirement Committee meeting on January 15th. But I wouldn't suggest that there's any urgency that you should attend that hearing, because what I'm going to present is what you've just seen. I might have another month's worth of data. That's about it. Okay. Any final comments or thoughts? Okay, thank you all.